Every few months, Wall Street resets the clock. Rate cuts were expected in early 2026, then in mid-year. Now Goldman Sachs says 2027. Each time, the reason is the same: the economy refuses to slow down. A May jobs report that doubled expectations. Wages that won't cool. Treasury yields rising without the Federal Reserve saying a word. The question is no longer when cuts arrive, it's whether this economy will ever let them. As 2026 opened, the market's attention was fixed on the calendar. Investors, analysts, and corporate treasurers entered the year with a shared assumption: the Federal Reserve would soon begin to ease policy. Most forecasts pointed to a mid-year start for rate cuts, with some betting on the possibility of a move even earlier if inflation cooled or growth faltered. This expectation shaped everything from asset allocation to corporate financing plans. Portfolios leaned long duration and debt issuers mapped out windows to lock in lower costs. But as weeks passed, the target date for the first cut kept slipping. Each new economic release, whether on jobs, spending, or prices, seemed to reinforce the notion that the U.S. economy was not slowing enough to trigger a policy change. Instead of debating whether cuts would happen, the conversation shifted to when, with the consensus date inching further into the future each month. Market pricing followed suit, with futures contracts and swaps recalibrating to reflect the new reality. For investors, this moving target created a sense of whiplash. Positioning for an imminent cut became a test of conviction rather than a rational forecast. The longer the delay, the more it called into question the credibility of any strategy that relied on immediate easing. By spring, the question was no longer about the precise month of the first cut. It was about whether the underlying strength of the economy would allow for cuts at all. In this environment, timing policy became less a matter of prediction and more a matter of waiting for the data to finally break the pattern. Repeated delays in the timing of Federal Reserve rate cuts carry real consequences for investors, businesses, and anyone managing financial risk. The Fed's policy rate serves as the anchor for borrowing costs across the economy. When a rate cut appears imminent, companies rush to refinance debt, households eye lower mortgage rates, and portfolio managers extend duration to lock in higher yields before the window closes. But when each strong jobs report or upward payroll revision pushes that cut further into the future, the costs of waiting add up. Higher for longer rates mean that financing remains expensive. For corporate treasurers, the calculus changes. Issuing new bonds or rolling over loans becomes a bet on whether yields might drop or whether it's safer to lock in current rates before they rise again. Cash managers, too, must weigh the opportunity cost of holding short-term assets that may not benefit from falling rates for months or even years. Portfolio strategies built around the prospect of imminent easing, such as favoring long-duration treasuries or rate-sensitive stocks, face greater risk as the cut calendar drifts out. This environment sharpens the core puzzle. Strong economic data, once seen as a positive, now acts as a barrier to policy easing. Each upside surprise on jobs or wages reinforces the Fed's case for patience, not action. Instead of simply trying to guess the date of the first cut, markets are forced to ask whether the underlying strength of the economy justifies keeping rates elevated for much longer. For investors and business leaders alike, the debate is no longer about timing alone, but about whether the conditions for easing will materialize at all. On June 5, 2026, the Bureau of Labor Statistics released its May employment report, delivering a result that caught nearly every market participant off guard. Non-farm payrolls rose by 172,000, double the consensus forecast of 85,000. Analysts had spent weeks preparing for a slowdown, with estimates ranging from 60,000 to just above 100,000. Instead, the headline number landed well above even the most optimistic projections, forcing a recalibration of expectations in real time. This single data point did more than just surprise on the upside. It interrupted the narrative that had been building for months. a story of gradual cooling, of a labor market inching closer to the threshold that would finally allow the Federal Reserve to ease policy. Instead, the report pointed to an economy still creating jobs at a pace inconsistent with imminent rate cuts. The unemployment rate remained unchanged at 4.3%, while average hourly earnings grew 0.3% for the month and 3.4% year over year. These figures, taken together, signaled a labor market that remains resilient and tight, with wage growth still outpacing the pre-pandemic norm. For investors and policymakers, the significance of the May report was not just in the magnitude of the payroll gain, but in what it revealed about underlying momentum. The Bureau of Labor Statistics, as the official source, provided the institutional shock that forced a shift in the rate cut debate. What had been a conversation about timing became a question of evidence. If the labor market can absorb higher rates and still add jobs at this clip, then the rationale for easing weakens. The May headline transformed the outlook, making it clear that each upside surprise is not just a delay, but a direct challenge to the idea that cuts are needed soon. April's payroll figures delivered another surprise, with the Bureau of Labor Statistics revising the headline up to 179,000 jobs. This upward adjustment, coming on the heels of a strong May report, added weight to the argument that the labor market remains resilient. Unemployment held steady at 4.3%, a level that has shown little movement for nearly a year. This stability, even as job growth continues, points to an economy that is still absorbing higher interest rates without shedding workers at a pace that would justify policy easing. Average hourly earnings rose 0.3% month over month and 3.4% year over year. While wage growth has moderated from post-pandemic highs, it remains above the pre-2020 trend. For the Federal Reserve, this is a critical detail. As long as wages keep rising faster than the 2% inflation target, the risk of renewed price pressure lingers in the background. The Fed's mandate requires evidence that wage growth is no longer feeding into persistent inflation before considering cuts. Behind the headline numbers, the mechanics of payroll estimation play a crucial role. Initial job figures are always preliminary, subject to revision as more employer data arrives. The 2025 benchmark cycle, completed earlier this year, sharply lowered the prior year's payroll history, reminding analysts that the labor market can look very different after the fact. Still, the recent trend in revisions has been upward, not downward. Each time the data is updated, the story told is one of continued job creation, not a hidden slowdown. For policy, this means the labor market is not offering the clear signal of weakness the Fed would need to justify rate cuts. As long as payrolls are revised higher, unemployment stays anchored, and wages remain firm, the central bank faces little pressure to ease. The data, in effect, keeps the door to cuts closed, reinforcing the narrative that strong economic fundamentals are the primary obstacle to any shift in policy. The bond market delivered its verdict on the morning of June 5th. Without waiting for fresh guidance from the Federal Reserve, Treasury yields swung sharply higher. The 10-year yield, which had hovered near 4.47% before the jobs report, surged to 4.54% within minutes. The 2-year note, often the clearest gauge of near-term policy expectations, jumped to 4.16%. These moves reflected a swift reassessment. Investors saw the strong labor data as evidence that the Fed would keep rates elevated for longer, making near-term easing less likely. This was not a case of the central bank signaling a new stance. The Fed's official position remained unchanged. Policy decisions would continue to depend on incoming data, yet futures and swaps markets wasted no time in recalibrating. Fed funds. Futures contracts, which encode collective bets on the timing of the first cut, quickly priced in lower odds of a move this year. The message from the Treasury market was clear: a resilient labor market means financing conditions will stay tight and borrowers should not expect relief soon. In this environment, markets interpret the data and move first, often well before policymakers speak. On June 8, 2026, Goldman Sachs shifted its forecast, moving expected Federal Reserve rate cuts into 2027. Their note cited persistent inflation and steady growth, marking a turning point as major sell-side research joined the consensus that easing would not arrive this year. The next inflection comes with the June 10th Consumer Price Index release. Consensus expects headline Consumer Price Index to rise 0.23% month-over-month, 2.6% year-over-year, and core inflation to reach 3.0%. These figures now set the stage. If inflation holds firm, the prospect of cuts drifts further away. A gentle cooling would keep late 2026 easing in play, while a sharper drop could reopen the door to earlier moves. There remains a faint risk of stagflation, with high inflation and slowing growth keeping the possibility of further hikes alive. For those managing duration, cash, or financing, the Goldman Sachs note and the Consumer Price Index release shape every decision as the policy debate sharpens. Today, with payrolls up 172,000 and unemployment steady at 4.3%, the case for rate cuts grows weaker, not stronger. Until data signals a clear slowdown, the Fed remains sidelined. For markets, the real debate now is not when, but if easing can even begin. Share your perspective below.
Headlines tell you what happened. Signals tell you what happens next.